Okay, this first video will just be an introduction to what is meant by budgetary policy and some of the key revenue and expenditure items that are associated with the budget. So first of all, budgetary policy refers to the anticipated changes in revenues and expenses throughout the next year, as well as estimates for several years thereafter. So the budget is forward-looking. It's announced in May, and it basically is going to compare the expenses and revenues for the government for the next financial year, so from July to June. The main role of budgetary policy is to improve the welfare or living standards of society. The ultimate goal of the budget is to achieve the most efficient allocation of resources possible to maximise our living standards. So basically it's allocative efficiency, where resources are being used in the way to maximise society's material and non-material living standards. The budget can also be used to achieve each of the other 5 economic goals we studied in Unit 1, so full employment, growth, equity, external stability and inflation, but its main aim is to achieve an efficient allocation of resources. Basically, the budget represents around 25% of our GDP. So what I mean by that is Australia's GDP is around $1.6 trillion, and the government collects around $400 billion in revenue and pays slightly more in expenses every single year. So the budget is approximately 25% of our GDP, or the revenue and expenditure is about 25% of our total GDP. So if these revenue and expenditure items change, so for example, if the government collects more revenue, that can have a big impact on our GDP and on our economy. Alright, so first of all, we'll start with the main forms of revenue the government collects. And the main forms of revenue, not all of their revenue, but the majority is through taxes. And will either come through direct taxes or indirect taxes. So taxes that are direct are basically taxes that are paid based on our income, and that will include income tax is the main one, company taxes. It also includes capital gains tax that you would pay on properties and shares, as well as taxes you pay on your superannuation or any fringe benefits tax. But basically direct taxes means taxes on your income, whereas indirect taxes are taxes on your spending or your purchases. So examples of indirect taxes are things like the excise tax, GST, anything you're spending when you're purchasing a product. Cigarettes, alcohol taxes, petrol taxes. Most indirect taxes are regressive because low-income earners pay a greater percentage of their income. So the excise tax on smoking is a good example of that. The tax represents a higher proportion of low-income salary, and also low-income earners have more of a tendency to smoke as well, so it definitely has a regressive impact. So here's the revenue mix for Australia at the moment. We've got 48% of our revenue comes from income tax, and then you've got 18% from company tax. They're the main two, income and company tax. And you've got 24% from indirect taxes, so that would include GST, any excise taxes. In the past it would include the carbon tax. And then 2% from other taxes. So that might include superannuation tax. No, it doesn't include superannuation tax, that's down there. It may include fringe benefits tax, and things like that. Revenue is expected to increase in 2016-2017 by 6%, and the main reason for that is that because of bracket creep. Because we're experiencing inflation, even though it's not that high, people are getting pushed into higher tax brackets, and that's helping the government to collect a lot more individual income tax. Unfortunately, company tax has been falling, and that's because of the mining boom ending and companies making less profit. And that's to do with the lower terms of trade. Our main expenses, welfare or social security, and then health, defence, and education is some of our other big ones. Expenses are continuing to rise by around 4.7%. So if Australia runs a budget deficit, it means that our expenses are higher than our revenue. So in Australia, these expenses are around $37 billion higher than our total revenue. Interest would be one of the government's expenses, but it's quite a small part of the pie, basically. Interest only really accounts for around 1% of government expenditure, so it's quite small. There's also non-tax revenue. Non-tax revenue for the government would include any money they get from HECS repayments. So when you're paying back your HECS, even though that would be an expenditure for the government for education in the short term, when you pay it back, it's classified as a form of revenue. Any profits they run from government business enterprises, and any dividends they collect on any of their investments would go in here as well. So here's what's happening with our budget in the last sort of 25 years, sort of. So basically we ran deficits all the way up to 97, 98. In the Howard and Costello years, we ran a period of around 10 budget surpluses in a row with one slight blip. And basically during that period we were able to eradicate our debt. By running constant surpluses, by earning more than we spent, we were able to eradicate nearly $200 billion of debt. But unfortunately, over the last 7 or 8 years and into the future, we're going to be running budget deficits, which is going to continue to make our debt grow. Even though these deficits are going down, they are still deficits, so we're still spending more than we're earning. So even in this period here, our debt will still be growing. As you can see, this is Australia here. Our debt is around 19% of our GDP, and look, that's pretty small compared to most developing nations, so we're nowhere near a crisis. Our government debt's around 19% of our GDP. Our total debt is now over 60%, but over 2/3 of that is private debt. And we're not talking about that in this chapter, we're just talking about the government section of debt. Government debt is expected to grow from about $285 billion to $326 billion in the next year, but that's nothing compared to some of the advanced economies around the world that have debt, in some instances above 100% of their GDP. Thank you. Next video, automatic and discretionary stabilizers.